Insurers have long invested in structured securities to diversify their fixed income portfolios. Here to discuss the latest trends and how interest rates are impacting strategies as part of an AM Best report is Jason Hopper, Associate Director, Industry Analytics and Research, and Helen Andersen, Industry Analyst, both of AM Best. And Jason, insurers hiked their structured security investments in 2021 as they have in most recent years, but indications for 2022 paint an uncertain picture. What's driving that?
So since 2020, obviously there's been many economic and macro credit challenges that have surfaced, starting with the beginning of the pandemic. Then you have the rising interest rate environment in 2022. You have inflationary pressures. We may see some monetary tightening policy come through. So there's a lot of uncertainty and instability within the markets over the past year plus. So insurers are going to be taking into account credit spreads and secondary market yields and those types of factors to see if they're going to continue increasing allocations. Obviously, issuance levels plays a part in that as well. But those are the type of factors that are looking down the pike heading into 2023.
How have the housing market trends, along with the interest rates, impacted insurer allocations?
Sure. So towards the beginning of the pandemic, obviously, commercial real estate had a big question surrounding it. The work from home environment, offices, retail, those sorts of properties, will trends continue as they have been. Looking at 2022, rising interest rate environment, mortgage rates are going up, so that's going to impact and depress most likely the residential housing market. So you have those two factors. Some CLOs and some commercial mortgage-backed securities are floating rate, so that may be of interest to insurers, but we'll see what their risk tolerance is. It varies from company to company. Whether they can increase allocations to that. But on the flip side, with issuances down being mostly across the board, I think except for maybe credit cards, but we have seen more appetite for non-traditional types of structured securities, such as rental, leases, or solar. So again, depending on risk tolerance levels, insurers may be looking kind of outside the standard box of thinking, if you will.
Helen, collateral loan obligations have become a popular investment class. Is there a risk to insurers going heavy on CLOs?
So, CLOs are complex instruments and they require a rigorous due diligence and research into the underlying collateral pool. And some CLOs have an underlying asset pool with over 200 issuers. And understanding the structural characteristics of a CLO is also hugely important because structural differences between two CLOs with identical asset pools can cause performance differences. Another risk to be cognizant of is that while rising interest rates may make CLOs more attractive due to floating rates, they can also put the underlying collateral into jeopardy because higher rates makes financing more expensive for many borrowers, making it more difficult to service the loans and can potentially weaken their credit.
When you look at trends by industry segment, is there anything that's jumping out at you?
So the life annuity industry holds the majority of structured securities, and they make up about a third of the total bond portfolio for life annuity insurers, and that's been pretty consistent over the last decade or so. By contrast, the health industry has the smallest dollar amount in structured securities, but are relatively overweighted. Their structured securities make up about 40% of total bonds held by health insurers. And when we look at allocation, both health and PC insurers invest more heavily in residential mortgage-backed securities than life insurers, and life insurers invest more heavily in CLOs than either health or PC insurers.
Thanks, Helen. Jason?
Thanks, John.
Thanks, John.
That was Jason Hopper, Associate Director, Industry Analytics and Research, and Helen Andersen, Industry Analyst, both of AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.